Welcome to Markets Without Spin, the podcast that cuts through financial media noise to examine what's really happening in markets and the global economy. I'm Franz Amundsen. Before we get into today's topic, let's do a quick recap of where we left off in episode 2. In our last episode, we talked about how modern compensation systems shape corporate behavior, from stock-based awards to the way executives communicate with the market, to how buybacks are used and marketed as returning capital to shareholders. We looked at how these incentives can push leadership towards short-term decisions, even when the public messaging emphasizes long-term vision. Today, we're going to take that discussion one step further, because if you really want to understand why executives behave the way they do, you have to examine not just the compensation structure, but the entire incentive ecosystem around it. And that brings us to one of the most misunderstood concepts in investing: the idea that corporate executives are aligned with shareholders. Most investors assume that when a CEO says, "I'm confident in our long-term strategy," they think they act like owners. But after almost 4 decades in this industry, I can tell you that belief is mostly a myth. Executive alignment photographs well. It reads well in annual reports, but the way incentives are structured today pushes executives toward extraction, not ownership. So in this episode 3, we're pulling back the curtain on how stock-based compensation really works, how executives extract value through dilution and buybacks, what Form 4 filings actually reveal, and how the system enables insiders to harvest gains long before long-term shareholders even see them. In this episode, we examine the mechanics, the paper trail, that very few investors look at, but every investor should understand. So let's dive in. Let's talk about the illusion of alignment. Executives don't buy stock the way you and I do. They are granted shares, usually in 3 buckets: restricted stock units, awarded simply for staying employed; performance-based share units, awarded for hitting short-term targets; and stock option packages, giving executives the right to buy shares at a discount if the stock rises. And here's the key point: executives do not pay for these awards. Shareholders do, through dilution. And these awards reset about every 12 months. Executives just need the stock to behave during the next vesting window, typically 6 to 24 months. That's not alignment. That's a short-term incentive clock. Everything I'm about to describe is public. It is disclosed in a document almost nobody reads. It's called the proxy statement. Most investors read the glossy annual report, if they read anything at all. Very few even open the proxy statement, even though the proxy shows exactly how executives are paid. Inside the proxy statement are tables that reveal how many restricted shares were granted, how many performance-based shares were awarded, the size of option packages, the dollar value of all awards, and the new shares that will be issued. This is the dilution that shareholders will absorb, the shareholders that actually paid for their shares. This dilution isn't hidden. It's right there in black and white, quantified down to the share. And this is where the cycle begins. Step 1, the board grants executive tens of millions of dollars in stock-based awards. The share count expands instantly. Most shareholders never even notice. Step 2, to offset the dilution and to keep the stock elevated, the company increases share buybacks, always described as returning capital to shareholders. But the timing of buybacks frequently lines up with the vesting schedule of executive awards. Step 3, Buybacks support the stock price at the exact moment executives need liquidity. Step 4. Executives sell the newly acquired shares openly, and these sales appear in Form 4 filings with the Securities and Exchange Commission. The selling often occurs exactly when buybacks are most aggressive. Step 5. The cycle resets the following year with a new round of stock awards, which creates new dilution, which requires more buybacks, which enables more insider selling. More dilution, more buybacks, more selling. It's elegant, it's legal, it's engineered. And once you see the cycle clearly, it becomes impossible to unsee it. Let's look at NVIDIA, one of the most successful technology companies in the world. In 2025, its CEO adopted a pre-scheduled plan to sell roughly 6 million shares worth over $800 million, while other senior executives set up large selling plans of their own, all while the stock was rallying. These sales were disclosed in public filings with the U.S. Securities and Exchange Commission, and they illustrate perfectly how insiders lock in gains as the stock rises. And according to the SEC research, insiders across the broader market are more than twice as likely to sell stock in the days following buyback announcements than in the days before. The average sell during that period is multiple times larger than normal trading. There's a simple way to understand modern executive compensation. The stock is a paycheck, not ownership. So people often wonder, can the system be changed? Yes, but not without structural reform. We would need binding shareholder votes on compensation. Right now, they're just advisory. If they were binding, everything might change overnight. We need to have compensation committees selected by shareholders, not by the CEO, not by the board chair, actual shareholder selected oversight. Full disclosure of buybacks, stock award vesting, and insider selling on one timeline. If this were required, the extraction cycle would become unmistakable. If you want to know what executives really think about their company's future, don't listen to the earnings calls. Look at the Form 4 filings with the U.S. SEC. Across hundreds of companies, the pattern is identical. Executives sell into strength. They sell after upbeat guidance. They sell after investor days. They sell after major announcements. They sell after buybacks surge. While they're publicly expressing confidence, they're privately reducing exposure. Public optimism, private liquidation. So it's the hypocrisy loop. This is not about one or two bad apples, it's systematic. A CEO sells tens of millions in stock the same week they urge investors to think long term. A chief financial officer quietly lowers exposure right before a revenue slowdown. Boards issue retention shares immediately after poor quarters to motivate leadership. This isn't scandal, it's design. Executives get paid first, shareholders take the risk. And this brings us to the question almost every listener is probably asking right now. Isn't this insider trading? Well, it certainly looks like insider trading. The timing, the pattern, the consistency. But here's the part that most investors never think about. It's not considered insider trading, not under current rules, because the system is built to avoid that charge. Let's break down why insiders almost never face consequences for behavior that looks suspicious. The first thing they do is they pre-schedule selling plans to provide legal insulation. Executives file plans that automatically trigger future sales. Once the plan exists, they can claim they had no role in the timing, even though they can cancel the plan anytime with no waiting period. In other words, they can sell when things are bad and delay when things are good. Regulators must prove intent, almost impossible. Executives always say they sold for estate planning, taxes, diversification, liquidity, and these explanations are very difficult to disprove. Corporate legal teams structure everything. Compliance officers ensure transactions stay within technical boundaries. Insider trading laws were written decades ago, long before modern stock-based compensation existed. Regulators focus on blatant cases, not structural exploitation. Senior executives rarely face charges. What looks like insider trading is often perfectly legal under today's rules. Now, all of this selling would be harder if insiders faced real downward pressure on the stock. But in today's market, they rarely do. 20 years ago, insider selling could move markets. Not anymore. Index funds are like giant vacuum cleaners running 24 hours a day, constantly pulling shares off the market no matter the price, no matter the news. These passive flows create a permanent bid that absorbs insider selling almost effortlessly. Executives know this, and they take full advantage of it. It's the smoothest exit ramp corporate insiders have ever had. This isn't criminal corruption, it's structural. Executives influence compensation committees. Consultants justify bigger grants every year. Boards rubber stamp everything. And shareholders rarely read proxy statements. Short-term targets, short-term rewards, short-term liquidity. The structure produces this behavior. Most investors aren't losing because they're uninformed. They're losing because the rules of the game were never explained to them. Before we wrap up, here's a quick summary of today's episode. We broke down the myth of executive alignment. We explained how stock-based compensation really works. We walked through the extraction cycle, buybacks to awards to insider selling. We examined proxy statements and Form 4 filings and pre-scheduled selling plans. And we showed how passive index flows create a frictionless insider exit ramp. In the next episode, we shift from incentives to market plumbing, the hidden architecture that drives market behavior, indexing, liquidity, ETFs, market makers, and why fundamentals often take a back seat to flows. If you're enjoying Markets Without Spin, please share the podcast, leave a review, and send it to someone who cares about markets but hates the spin as much as you do. This is Franz Amundsen. Thanks for listening, and I'll see you in the next episode.